2025. Andy, thanks for coming back on Liberty and Finance.
And again, it's wonderful to see your smiling face again. Sorry I wasn't here last week. In an attempt to unwind and unplug a little bit, I took a cruise through the Caribbean. And in typical fashion, I spent most of my free time reading and researching. But, I guess it kind of relaxes me, actually. I find it very stressful to fall behind in a world that seems to be spinning faster and faster, as we've discussed, where it seems like I age years every month. I have to stay caught up, and it relaxes me. So there's a lot to talk about, and it's good to be back again and chatting about what's happening in this crazy world. How are you doing?
I'm doing very well, and very grateful that you're back. And I'm actually very, very grateful that you got a getaway last week.
It's important. Thank you. It is. It's important for everyone to unplug, however they do so. And kind of hard for me, but this was great. I laid on a chair over the ocean, basically, and read and have tried to keep up with the ever-changing pace at which things seem to be moving, so we can jump right in. And then I have, I write them down when I find something that it sticks out to me. So some of it will not really be in any particular order, but I try and look at stuff with the BRICS, with the dollar, with interest rates, with everything that follows this narrative, and then some. And I found some really interesting things to chat about. So why don't we jump right in? We had talked before about the Shanghai Gold Exchange and the progress that they've made in both Saudi Arabia and in Hong Kong in this new vaulting structure. So I want to talk a little bit about that because there has been something in the way of updates. We went back to the beginning of May and we talked about the Saudis had opened up an account at the Shanghai Gold Exchange. And in fact, it had been officially launched. And what it was realizing was a two-way free exchange between renminbi and gold. And at the same time, it's facilitating Middle East investors to directly participate in the Shanghai Gold transactions through the Saudi Treasury. So on June 26th, the Shanghai Gold Exchange opened its international board, a designated warehouse in Hong Kong, and it launched these contracts. We talked about that. What I did just realize is that on the first day, many Chinese and foreign institutions successfully reached transaction. And so this is now in motion. We are seeing countries trading their renminbi, their yuan, directly into the Shanghai Gold Exchange, which is China's official platform for gold trading, by the way. And they're doing it directly without needing, the key to it is that they're doing it directly without needing intermediaries or converting through other currencies like the US dollar. So for investors, this provides opportunities and more efficient access to the gold market. And for Saudi Arabia and China, it puts them closer together. It slices apart, the petrodollar. It gives other options to settle in yuan or renminbi, and then immediately convert it into gold. These are the little pieces, the little by little, the chess pieces that are being put into place that are very, very difficult once fully in place to disrupt. And there'll be more about this in a moment when I get into the BRICS pay. But suffice it to say, this is a big deal. It is now operational. Gold is being delivered in the warehouse in Hong Kong. And the next one that is being built right now is in Saudi Arabia. Saudi Arabia is already set up in Hong Kong. And through the treasury in Saudi Arabia, other Middle Eastern nations will be able to participate. I was watching Andrew Maguire the other day. I love Andrew Maguire. I don't know if you've had him on your show, but he's one of my favorites. And through his sources, whoever they are, he said that the Chinese insurance companies in June raised the amount that insurance companies can invest into gold from 1% to 2%. That's 25% of global mine supply if that's the case. And he's saying that a possible increase to 10% in 2026, you're talking all of global mine supply just from a 10% toe in the water by Chinese insurance companies.
I just want to just jump in there because you've been telling us for at least 2 years now about Saudi Arabia being a key linchpin in the BRICS strategy because of its key role in the petrodollar since Kissinger got that all worked out, decades and decades ago. This is an absolute watershed moment and a pivot. They've been a key ally of the U.S. They've been received favored nation status in so many ways. We could spend all day talking about that from the U.S. And here's they're getting completely plugged in with the Chinese system for their non-dollar and non-U.S. and non-SWIFT system, cross-border payment settling and that sort of thing. Absolutely key and critical. And then you just mentioned the last part, the insurance company investing in gold. We have so far we keep asking the question, if individual viewers of our channel have been taking preparedness steps and taking care of their family's financial future by getting some of their savings and their nest egg and their retirement out of the system, out of the banks, out of the stock market, out of ETFs and into physical precious metals as a way of protecting themselves and hedging them also against uncertainty, inflation, government overreach and wars and all kinds of things that are potentially possible to upset their apple cart going forward. But we have not been hearing this about insurance companies who are supposedly backstopping pension risk transfer for people's retirements and on and on and on, even though some states in the U.S. have authorized their rainy day funds to be partially invested in precious metals. But I think it's absolutely telling that you have other major entities in the world like this taking that position on behalf of their treasury to protect the treasury of their insurance company. Very interesting.
Yeah, well, and they have the state-sponsored accumulation programs for Chinese housewives. I mean, they're pushing their populace into owning gold. You can see this is a bigger deal than just the state owning it. They see a benefit in their public, in their constituents across all of China to own gold. And in all of the provinces, it's not just in Shanghai, it's a big deal. An interview that I watched last night blew my mind. And it supports a lot of what I've been saying. It's with the BRICS-Pay CEO. His name is Andrei Mikhailishin. I'm butchering that for sure, but he's the BRICS-Pay CEO, chairman and founder, Andrei Mikhailishin. Anyways, sorry, Andre, for butchering your name. I'm sure I did, but some things that he talked about BRICS-Pay. Now, first of all, one of the questions that was asked of him, and we fortunately got this right, was what's the difference between BRICS-Pay and BRICS-Bridge? He said BRICS-Bridge is basically mBridge, and it is a technology that is fully backed, as we know, by China, Hong Kong, Thailand, UAE, and Saudi Arabia. They're the 5 main participants in the BRICS-Bridge technology, formerly mBridge, and it is, as he said, a cross-border CBDC platform for central banks from Saudi Arabia to China or whatnot. And now one of the big things that we talked about last time I was on your show was the expansion, according to Sergei Lavrov, of the BRICS-Bridge platform into non-BRICS countries. I mentioned the Belt Road specifically, 150 plus countries, 75% of human population, north of 50% of global GDP. They were going to use BRICS-Bridge for these central banks to trade with one another. Think of the new Shanghai Gold program. So they will trade with one another across the bridge, free from SWIFT interference, in local currencies, and then settle imbalances in gold. We were spot on that. Very early to say that, spot on, and that's just the beginning. Well, he also talked about BRICS-Pay. Now, BRICS-Pay is a technology that is B2B, business to business. It is consumer to business, business to consumer. It is bank to bank. It is one notch below the BRICS Bridge program. It is also free from SWIFT interference. They talked about having aspirations of at some point of being integrated with things like Visa and MasterCard, but they're not because of the sanctions that are put on Russia and Iran. And this is primarily being driven by the Russians right now, the BRICS pay platform. So they are completely autonomous from the West. But he did say that in the future, he sees BRICS Pay and BRICS Bridge being combined, so that you have the central bank portion, you have the B2B portion, all under one kind of big package of breaking free from the West. He said currently their representatives are in China to develop BRIC Pay technology throughout the Belt Road. How do you like that? So the Belt Road is being already integrated. We know this through the BRICS Bridge. And now they're going to open up BRICS Pay on the Belt Road. So not only will the countries trade with one another as China industrializes them, as they pull the natural resources out of the ground, as they build the infrastructure to industrialize these third world countries in Africa and Asia and South America, they will do so free from SWIFT interference over the BRICS Bridge and settle imbalances in gold through the Shanghai Gold Exchange and all the other exchanges like the one in Singapore and Moscow, the BRICS Exchange. All of these other exchanges will be integrated into this system. But now they have their representatives negotiating in China right now to use BRICS Pay amongst the Belt Road. This is massive, right? So you get all of these business to business, bank to bank, like the commercial banks, regional banks, not the big central banks. That's the bridge. But BRICS Pay would be bank to bank, business to business, business to consumer, etc., integrated through the Belt Road. That is a massive, massive, massive development. And I think it's something that should not be overlooked. He said something, Dunnigan, that kind of was one of these bang moments. And I'm like, holy crap, what did he just say? And I had to stop and rewind it, because I bet you no one has heard this before, but I want you all to think about this in terms of stablecoin and in terms of the digital world we are moving into. He said, and I quote, well, I don't quote, I'm paraphrasing, but pretty close to a quote. He says, they asked him, the gal asked him, she said, there's a lot of terrorism out there and bad people, and how you're not going to be financing terrorism or bad people, more or less. And he said, this is open, guess what he said, to non-BRICS countries as well. BRICS Pay. Not compatible in the West yet, just like BRICS Bridge, but it's open to non-BRICS members. So you're talking expansion, massive expansion. This is what the BRICS naysayers never caught on to. They didn't catch on to it yet with the BRICS Bridge. We did, and we said by Lavrov opening it up to the non-BRICS countries, you have just ignited a fuse under the dollar. Because now it's not just the 10 BRICS countries. You're talking the majority of human population when you throw in the Belt Road, the Shanghai Cooperation Organization, the Eurasian Economic Union, the BRICS, and all of the other countries, like the countries in Southeast Asia, the Eurasian countries or the Asian countries rather, that have just signed up to BRICS Bridge. They in and of themselves, with the 5 Middle Eastern countries that did represent 38% of global GDP. Now you open all of this up to non-BRICS countries, bang. Well, now they're opening BRICS Pay to non-BRICS countries, right? So he said something really blew my mind, and I've never heard this before. Now, granted, the reason I left my corporate office in Minnesota is because it's the only state in America, and again, they're now re-implementing it, licensing and bonding. And so we're very attuned to anti-money laundering laws and know your client legislation. They said, well, how you're not funding terrorism? And he said, well, because we're opening this up to other countries, we are keenly aware of compliance issues in all of these countries. And he said, our software is compliant with AML, anti-money laundering laws, and KYC. Now, you know that, right? You know what KYT is?
I do not.
Neither do I, until I Googled it. and figured it out. Well, I listened to what he said. I rewinded it again. He said, our software is compliant with KYC, AML, and KYT. Now, before I tell you what KYT is, I want you all to think about this in terms of stablecoin and this digital surveillance world we've been warning you about. That a lot of people say that these stablecoins are kind of like a CBDC in sheep's clothing, kind of like it still gives the central authorities the ability to monitor, to track the on-ramp and the off-ramp, do all these things. Well, guess what KYT stands for? Know your transactions. So their software is compliant with know your customer, anti-money laundering, and know your transactions. So guess what? What you are buying ultimately is going to be part of this software. You go and buy a couple AR-15s for your home protection, may not be a good idea. You go buy bullets, you go buy alcohol, you go buy cigarette, whatever it is that you're going to buy, guess what? It's going to be known. And that's part of this whole new digital ecosystem. I think it's kind of scary if you ask me, but I'd never heard that before, as you. And you and I are pretty well in tune to this kind of stuff. I don't know if you have any thoughts on that, but I thought it was kind of concerning myself.
Yeah, that is one of the concerns that we have. In fact, with this is hidden in the big, beautiful bill, so-called, is a 10-year moratorium on states being able to do any limiting of AI, for example, that comes out at the federal level. And it's very concerning, since we've had an emphasis on supporting people's right to privacy from the very beginning. And it's something that you have emphasized throughout your visits with us, that Miles Franklin always does, whatever can be done within the law to protect people's privacy. That the idea that we have a right to, the fruits of our labors, and to keep those in a form of our choosing, and to do that in a way that's private, so that we can do with it as we choose, when we choose, within the law. And that's very concerning when you see what could be just massive expansions of essentially electronic surveillance and financial surveillance, which turns into the ability to track and control every aspect of people's lives to a large extent, is because their lives are lived out through financial transactions in many respects.
All right, so now I'd like to maybe switch gears a little bit and move to precious metals, gold, silver, platinum, to talk about a few things that I saw. And you stop me at any point. We can talk about anything that we've talked about so far. Okay, so I've been thinking a lot about the gold to silver ratio, and you got Goldman Sachs and JP Morgan forecasting $4,000 gold by next year. I think that's pretty reasonable, actually, on many levels. But assuming that plays out and the gold to silver ratio were to get to 50 to 1, where it's averaged about 45 to 1 for the last 150 years, at 50 to 1, which is very conservative, at a $4,000 gold ratio, that puts silver at $80 an ounce. I mean, you're talking a double, easy double. And so when I think about where silver could ultimately go, there are so many things that are screaming silver and its value right now. UBS just raised its target to $42 an ounce. That's about an 11% increase. But when you look at all of the things that have been happening, to me, whether it be the increase in the lease rate, the lack of shares available to short or to buy to cover shorts on SLV, the massive delay from T+1 settlement in London to T+8 weeks in London, the huge deliveries. When you look at the distortions that we find in the silver market, when you look at a simple returning to 50 to 1, even if you went to 70 to 1, where it was just a couple of years ago, that puts silver at basically $60 an ounce. That's a solid, 50% gain almost. So you're talking about, I think, the value of a generation. And it seems that things are changing. The way that the market is moving. We're not seeing these massive sell-offs. We're seeing consolidation, choppiness, volatility, but the strength is something that is very different than what we've witnessed before. I'm very, very, very hopeful for what the rest of the year brings for the price of silver. I find it interesting that the LBMA came out the other day and warned of counterfeited metal, which they said distorts prices by creating artificial supply. And you think about that for a second and think this is the institution that's trading billions in unallocated bullion contracts unbacked. Selling claims on gold and silver you can't deliver. Doesn't that kind of sound like you're creating artificial supply, counterfeiting in a digital form? I don't know. I'm just throw that out there. I laughed when I read that. But again, UBS is saying 38 to 42 through September 2025. They're talking just in a month through June 2026. So they're basically saying we're right there. By the way, for the people who we're recording this on Monday, the options expire today. So I expect today to be volatile, just like Friday was and Thursday, but I expect it to shoot right back up tomorrow. We'll see if I'm right when the next contract hits the board.
Yeah, that's something that I have a painful understanding of from having been schooled in that school of hard knocks in the stock market options expiries, where 2 or 3 days prior to expiration, you can be flying high and thinking, wow, looks like we're really heading for the next decimal, next decade, whatever. And then you notice just by some amazing hand of intervention, you just start to see that it gets guided down to right below some major threshold where as they say, it's where the maximum number of options expire worthless, and it favors them who are the sellers.
You have to wonder, is it a conspiracy or is it reality when you talk about when Chris Powell says there are no free markets, just manipulations? The traders suck in the speculators, and then right at the end, they smash the price so that the options expire worthless. The big banks get to keep the premium on that, and then it goes right back up. They rinse, wash, and repeat. But this is a game that's much more difficult to do so. And it kind of reeks like we're getting to the end of this game. We've heard that before, but the level of the spread in the exchange for physical jumping up 250% last week, the no shares available to borrow of SLV, none, when there's usually millions. The 7 or 8% lease rate, highest I've ever seen, the T plus 8 weeks, the deliveries. Things are changing, and it's as dumb as a mud wall to continue this game. I think they know that. Also want to talk about perception. I wrote down homes are getting cheaper in gold. Now, homes aren't getting cheaper, but they are in gold. And, people talk about this real estate deal where homes are so unaffordable. They're not unaffordable in gold if you've been holding gold, because measured in dollars, you're getting crushed. Measured in gold, you're winning. Since 2005, it's fallen off a chart. It's gone straight down. The amount of gold that you need to buy a home, it's at almost all-time lows or very darn close to it. So in other words, gold is keeping pace. The dollar is not. This is the point that needs to be understood, is that gold is not here to make you wealthy. It is wealth that keeps pace with inflation. And that's really the bottom.
Morgan, we had him on just a couple weeks ago, and he was stressing this point. He says people feel that the stock market has been high flying, but the stock market has been, they say, well, just recently the stock market has been showing some volatility. It's like, no. He says that we've been in a falling stock market, a hidden falling stock market since roughly 2000 in terms of gold. So if there are how many ounces of gold it would take to buy the Dow or buy the S&P 500, we've been in a choppy and falling stock market for the past 2.5 decades in terms of gold.
Right. So if the average price of a house is like $400,000, you're talking what, 130 ounces of gold buys a house for you right now. So, what would it have been? If you look, I don't have the graph on my computer here. I wish I did. It didn't transfer for some reason. I thought I had it on there, but it's a falling just like this, where in gold ounces, if you would have bought gold and put the money instead of in the bank, because you're going to buy a house in 5 years, and you put it in gold, it's gotten cheaper and cheaper and cheaper and cheaper every single year. Even with house affordability going stratospheric, no one can afford a house any longer, it seems, with the cost of money and the increase in the price of houses.
picture perfect example of something that just burns me every time when I'm walking through the room and I hear the news commenters talking about something. There aren't, or a politician, they aren't talking about the underlying reality. They're talking about surface effects, and they'll say something like, housing affordability, the worst case ever. They don't say the dollar is worth less. In other words, a dollar affordability, dollar's losing all of its value. We are mismanaging the dollar. We're not telling you about that. We're not telling you about the destruction of your earnings, savings, and retirement, because it's much easier to point over here and point over there and say, oh, it's corporate greed, or oh, it's whatever. Not like we're destroying your earnings, savings, and retirement by destroying your dollar. We've been doing this since 1913. We've been doing it even faster since 1971. We've been doing it even faster. It's like that's what's really happening, and those who have woken up to that are few and far between. They know.
Well, let me expand on that, Dunnigan, and because this is my thesis right now. I believe they are going to intentionally destroy the dollar. They're going to destroy the dollar to support the system. I think what they're doing with the stablecoin legislation is they are trying to move the majority of debt issuance to the short end of the curve through stablecoin issue, because you are seeing the governments that used to support our debt are no longer doing so. Right? You have now the Cayman Islands and the United Kingdom and Ireland. It's a joke. And they understand that the amount of debt, we have to come up with $28 trillion in debt in 3 years when we only take in $15 trillion in tax revenue. We're not there. They understand that. And we're seeing less and less and less buying of our treasuries. So instead, they passed the stablecoin law where all of these stablecoins will be backed by US dollars in order to have demand for a treasury market that is losing demand. So you put that all on the short end of the curve, right? Where I think they're going to do it, and kind of blur the significance of the long end, which I'll get to in a moment. But I think that's first and foremost what they're trying to do. Remember when Janet Yellen did that? That was good for gold. That was good for stocks. It was inflationary. And I think that's what they're going to try to do. At the same time, they reshore all the gold and they're going to let it go higher and higher and higher and higher. Not very easy for the public to discern. There'll be volatility, there'll be consolidation, but it will keep going higher until people feel it's gotten too high. And then they'll probably come in and revalue it to a level much higher. And they're going to peg it to the treasury. Why would they do that? Why would they peg gold to the back end of the treasury market? The short end, the front end, will be backed by these stable coins, which they will pump out by the gazillions, because now they have this synthetic demand, not a organic demand like we used to have when we were revered and we ran a surplus and we didn't instigate wars all over the world and fund wars all over the world, and we're not revered anymore. So the back end of the market, who hell wants, and especially when Trump talks about creating all of this money to rebuild our infrastructure. So in essence, printing money to build our infrastructure to compete with the rest of the world. They don't want to buy our treasuries. So they will just do the stable coins to get all of this demand for the front end and load the debt there. But the back end, I believe they will peg to gold. As Judy Shelton has said, on July 4th, next year, the 250th anniversary, he has said it repeatedly. Again, she keeps saying it on Twitter. He will peg the 50-year treasury to gold. Why would you do that? And you have to get gold much higher. And I think she keeps talking about gold revaluation. They will revalue gold. And I think Luke Groman, one of the smartest dudes I've ever met, he's talking about revaluing gold. He thinks they'll let it go to $7,000, $8,000, $10,000 and then revalue it to a much higher level to give the Treasury General account $5-6 trillion in free, clear revenue without selling an ounce of gold. And we talked about how that happens. There's miscommunication on that too, because some people think that when the Treasury issues Treasury certificate or gold certificates, gives them to the Fed creates the money, takes the gold, and gives the Treasury money free and clear. Every $4,000 increase is $1 trillion free and clear to the TGA account. The Fed doesn't have control of that gold. They have control of the fiat. They're owed the money value of that gold, not the gold itself. Anyways, if they do that and peg it to the long end of the bond market, she said 50 years first, shorter durations, maybe 30 and 20, later, maybe 10. But why would you do that? Because now you can have zero borrowing costs. You can put a zero coupon on that. The gold redemption at the end is the borrowing, is the interest rate, is the inflation gauge. The more foolish we are in monetary policy, the higher the price of gold goes. To be able to get that at redemption would allow for long end low borrowing costs, almost down to nothing, which would then enable us to slowly reshore our manufacturing at very low borrowing costs, and then to grow our way out of this problem eventually. The only way you get rid of inflation and where we are right now is to produce our way out of it. And we're a long ways away from that, because in order to facilitate the amount of debt that we owe, pay it off, just the $28 trillion in maturing Treasury debt by 2028 with $15 trillion in revenue, we're halfway there. And that doesn't take into account the $3 trillion a year in deficit spending. So you're 25% of the way there. So you have to inflate. They're going to destroy the dollar. They're going to inflate the crap out of it. They're going to use the stablecoin legislation to front load debt issuance into the front end of the market. And then they will let gold go to the heavens. I believe this. Truly, I do. And they will peg it to the long end of the bond market to have zero borrowing costs, to reshore manufacturing, to sell treasury debt bonds at a much longer duration at a zero borrowing costs, redeemable in gold. I think they're going to do this. I truly do. And I guess we'll see. But I think to save in dollars now is the dumbest thing you can possibly do. You're destined to go broke. They're going to destroy the value of the dollar. They are going to inflate the crap out of it. There is no other way, period. So that is my thesis right now. And I'm very, very convinced that this is something that they are, if not implementing right now, it is, by all of the things that we hear and see. It'd be too long for me to go through the whole litany of them, but I think that's where we're going. So I'm sorry to get off track there, because I still have a few more things to talk about if we have more time.
Yep, we have.
I'll go quick.
I'm going to put a link in the description of this video to an article from Substack this week that treats some of the topic that you're talking about, is how cryptocurrencies and the proliferation of different options there have been are going to be and are being leveraged to create synthetic demand and infinitely scalable. And it really, they point out in this article how that really becomes part of a Ponzi scheme. And I want people to be aware of that. And it's even interesting, a very telling comment in here, as you were talking about the difference between the long end and the short end of the curve. And a guest whom we're going to have on again soon, Lynn Alden, was quoted in here, and they're talking about that ironically, in these kind of situations, the longer term, it says, just as long-term 30-year mortgages didn't prevent the 2008 crisis, any long-duration debt doesn't inherently eliminate systemic risk. It may even amplify it. And they go on to this and describe how that can be. It's quite eye-opening. I'm going to put a link to that in the description of this video for people who want to plunge a little deeper into what you were just describing about.
For sure. That's why they would have to have it pegged to something like gold and redeemable in gold, because the longer the duration, the higher the risk. And who the hell wants that? Especially from countries that are our competitors, our foes. They don't want to support the dollar anymore. And why would they? You can see the infrastructure with BRICS Bridge and BRICS Pay, et cetera. Let's go back to the metals. I found it really interesting. The head of the Japan Bullion Market Association, his name is, what is his name here? Oh, God. I don't have his, sorry. Oh, yeah, it is. Bruce Ikemizu, Ikemizu, formerly head of the Chinese bank ICBC Tokyo Precious Metals Desk, and now head of the Japan Bullion Market Association. He came out and said the market may already be broken. And he says London appears to have virtually no physical platinum available for delivery. He says that he thinks that there's basically no platinum in London and Zurich, and yet they're still trading nearly 3 million ounces a day of London promissory note cash contracts for immediate platinum ownership and delivery. I mean, he says something's about to break. What could possibly go wrong if you're trading 3 million ounces a day of promissory notes to deliver, and he thinks they virtually have nothing? And he says that because there's a 30% interest charge to borrow platinum. It's ridiculous. It's never been that high. He says he cannot recall a time where lease rates were even close to that high, and have rose that sharply. But when you talk about the banks that who borrow, or the producers, like recyclers, like jewelry manufacturers, industrial users, they're behind the banks, that they're the actual users who borrow from them. So why would you pay 30% interest to borrow? Why not just go buy it, flat out? And I think the frailty of the London platinum market it can very quickly just spill into the London silver market, which we've talked about, where you have lease rates at 7% for 1 month. I've never seen it that high in my career, ever. It's the same issue. They have no supply. Again, I think this is something to continue to watch. This is why I think things are changing in every way. And the rest of the world, they're wise to this. And they're kind of like the vultures circling the wounded animal. And then the wounded animal is the LBMA. A couple more things to talk about off topic. I found it interesting that Jeff Bezos has been on a selling spree since late June. He has sold $5.7 billion worth of Amazon stock. Now, if he thought that the stock market was going to go up and up and up, why would he sell $5.7 billion? This goes in line with all the other insider selling we've talked about ad nauseum. I also find it interesting talking about saving in dollars. You're destined to go broke. Well, part of what Trump wants is a weak dollar, right? If you revalue gold, by the way, what you do is you devalue the dollar. When Roosevelt increased the price of gold from 20 to 35, he did it by devaluing the dollar by 40%. He wants a weak dollar to make manufacturing more competitive. So part of bringing back the manufacturing and reshoring it, you have to have a weak dollar. Look what the dollar's done. It's fallen 11% this year. And so he wants a weak dollar. He wants low interest rates so that he can, and then ultimately, you have the stable coins front loading the short end of the market to facilitate debt. But then you peg gold to the back end to have zero borrowing costs to bring back your manufacturing with a weak dollar. He said yesterday, or the day before, that he likes a strong dollar, but you make a hell of a lot more money with a weaker one. He says, so when you have a strong dollar, one thing happens. It sounds good, but you don't have tourism, you can't sell tractors, you can't sell trucks, you can't sell anything. So he went on to say that manufacturers, would be the first to benefit from a falling dollar. Japan and China fought for weaker currencies for decades and were able to dominate markets over the years. Now it doesn't sound good, but you make a hell of a lot more money with a weaker dollar. These are the crumbs that I speak of that I've been following for 5 years. You find crumbs and either you take it for what it is and realize that these people who talk, part of their conscience comes out when they speak. They may not be fully honest, but they're telling you what they want. They want a weak dollar. He knows a weak dollar is a necessity. And that's where we're going. And the funny thing is that, look, as he goes on, as recently as 1999, the U.S. had a budget surplus and a debt of $5.6 trillion. We were widely admired, and the federal debt was bought as a monetary reserve all over the world. It isn't anymore. And, this is a problem, having a weaker dollar and lowering interest rates. So, one of the things that I found very interesting, this last article I read, was how home affordability is so high, and that lower interest rates would help, and would help first-time house buyers, as an example, with cheaper money. But think about this. We're so far down the rabbit hole. This is why things have to change. If we lower rates just to allow the anomaly to continue and for prices to continue to rise, how does that help a first-time home buyer? Lower interest rates, because of the printing and the buying of bonds, would cause all other prices, like food, fuel, insurance, taxes, upkeep, everything, rise, just like it's done in this low interest rate environment over the last decade, where asset prices have gone parabolic. And so, if they do lower rates, and all the talking heads will say what a great job they did by lowering rates, it's just going to spike inflation again. So the moral of the story is that the dollar is going to weaken further. You're going to see a weak dollar. You're going to see a situation where the Fed has no choice, the government does, but to print our way out of this problem, and then eventually reshore manufacturing to grow your way out. over the thesis that we talked about. But it has never, ever, ever been more important because of decades of low interest rates and money printed and inflated printing and inflated asset prices. It's never been more important to understand where we are going. I think that, it's interesting. One last piece. You have the equities, U.S. equities now at over 50 trillion. You have gold at over 3,400. You have Bitcoin at 120,000. You got all this stuff, crypto market cap at 4 trillion, that the economy is stagnant with GDP barely up 1% on the year. So you have stock prices outpacing corporate profits, trading at 30 times earning. You have Bitcoin going to the moon, but it creates no output. It doesn't create a profit. It creates no output. It's just a higher price, right? So much of the market value we see in stocks and crypto and everything, I read an article by Bill Bonner. He calls it ghost wealth, where it's enormous on paper, but disconnected from real production or income, where you aren't creating anything for the income. It's ghost wealth, and that's dangerous. You talk about stable coins being backed by U.S. Treasuries, so you have a stable coin backed by debt? Doesn't sound too stable to me. Let's see. Anything else? Sorry. Battling some allergy. Last thing I see here, annual buy now, pay later transaction volume is expected to reach a record 116.7 billion this year, double the 2022. Lending Tree survey showed that 25% of users now rely on buy now, pay later to buy groceries. I saw the article showed Adam Taggart had a piece up saying that it's being used to buy Chipotle burritos, up sharply from 14% last year, and 25% of buy now, pay later users missed at least one payment this year. Americans are piling on debt like never before. So that kind of covers everything that I found interesting over the last week. I'm sure there's a lot more, but you can sense this acceleration. I mean, things are starting to really move. And again, and I think now more than ever, people need to understand why we own gold. It is not to become wealthy. It is wealth. And it's going to back the new system. That I do believe. But being in dollars right now is really, for your financial health, the worst thing you can do. And we can see that on a myriad of metrics.
Interesting that we had Putin and heads of state across Africa and Eurasia saying exactly that over the last 2 to 3 years. They're just saying, folks, and to countries, to heads of countries and to central banks, if you're making plans, don't make those plans to include reliance on the U.S. dollar as you had in the past, because it's going to be a different situation, a different regime going forward.